You're listening to Smart Moves with your hosts, Ann Riley Caldwell and Matt Wilson.
Hey, welcome to Smart Moves podcast here with Ann Riley Caldwell, not your ordinary agent, and Matt Wilson, lender with New American Funding. And we're here today because we are going to bust a myth. Overall, we give you smart, hopefully smart, intel to make the best decisions for you when it comes to real estate and financing and sometimes even life. But today we're going to bust a huge myth that I don't know how it still exists, but you see it every single time. Fed rates, we hope that the Fed lowers interest rates so that mortgage rates will go down. Okay, so Matt, tell us if that's true or if that's a myth.
No, it's a myth. It's not true. There you go. Yeah. Podcast in 51 seconds.
Boom. There you go, people. So let's just say it again for those who keep thinking the same thing month after month and who ask us the same thing all the time. So when the Fed lowers interest rates, does it affect the mortgage rates directly?
No, it does not. Just go ahead and put this on just clip this out and put it on your phone. And every time you see on the news that the Fed's lowering interest rates, so the mortgages are going to get cheaper, play us saying this to yourself as a reminder. That's not true. Most of what you see in the news isn't entirely true. That isn't either. But we'll tell you how they do impact interest rates if that works for you.
Yeah, go for it.
So where the Fed does impact interest rates is this. Interest rates actually come from something called a mortgage-backed security. I've seen a lot of YouTubers and stuff get this all wrong. But essentially, when you've got an investor out there, anybody, Warren Buffett, whatever, investors can buy stocks like Apple, Tesla, Coca-Cola, whatever. Or if they would think it's going to be a safer bet for them, they can buy mortgage-backed securities or treasury bonds. Mortgage-backed securities are basically the money that's getting lent out to people for their mortgages. What is going on is the market's just moving money back and forth, The same way, it's just another investment out there. So the same way that, people decided to start flooding money into NVIDIA whenever the AI boom began. Well, back in 2020, whenever times sucked really bad for everybody economically, those same investors started taking all that money and putting it in mortgage-backed securities because they're like, well, I don't know. They're probably not going to sell it, Stock for Best Buy is probably not going to do great because people aren't exactly out here buying TVs right this second. Stock for Live Nation tanked, I'm sure, because nobody's out at concerts anymore. So they got to do something with their money, and they flooded over into the mortgage-backed securities and treasury bonds, right? Because those are the safer investments. That's actually kind of what led into 2008, was that they were the safer investments, and they got real stupid with what they were mixing into those safer investments. That's not the world we live in anymore. I always tell people, as the economy gets good, interest rates are going to get bad. It's kind of the natural checks and balances, because you think about it, if the economy is getting good, if it gets too good, we call that inflation, and things get more expensive. If it gets too bad, that's deflation, aka a recession. The problem is, no politician wants to be the head of the ship whenever the recession comes. So they'll do anything they can, including rebranding recessions over the last several years, to not say we've had a recession, right? Well, what the Fed's doing is when they raise rates or lower rates, they're changing rates for bank-to-bank lending, which in turn changes rates for your car loans, your home equity loans, your credit cards, and things like that. They're not actually directly impacting mortgage rates because they're not actually directly right now buying mortgage-backed securities. Now, during COVID and after 2008, they did buy mortgage-backed securities. And that also contributed to the rates going down. Because you got to think about it. The more money that's over there, the cheaper it's given out, right? It's just supply and demand. Everybody that's ever been to any kind of economics class knows supply and demand. The more of something there is, the less valuable it is. The less of something there is, the more valuable it's got to be. So in simplest terms, the Fed is, they're the gas and the brakes on the economy. And their moves are going to dictate what investors want to do. So as interest rates go up with the Fed, investors get a little worried about what's going on with the economy, and that's intentionally done. So they start moving money back over to mortgage-backed securities. So it's just like a big old economic seesaw, back and forth, back and forth. Now, let me ask you this: like, everybody tells me all the time, like, oh, I'd love for rates to just drop, a percent or two. I'm like, yeah, that'd be really cool. My wife and kids might not see me for a while I'm working those refinances, but like, what would happen to the real estate market if tomorrow we all woke up and you could get a 5% mortgage again?
Yeah, I mean, there's so many buyers sitting on the fence oftentimes if they're not fed up with where they're living, or they don't have some life transition thing going on, or they're not moving for their job. Those kinds of things are, kind of the foundation of the market, I would say, because you always have those types of transactions that are going to happen. But as we know, I mean, I talk to buyers all the time and they just say, oh, if interest rates would just go down a point or a point and a half, then I would jump into the market, or I would sell this house and I would upsize into another house. And the issue with that is it sounds great and I understand it because your payment's going to be less, but you're also watching all these other people dive into the market at the same time, which we went through about 3 to 4 years ago. And what that's going to do is it's going to take prices, and prices are going to rise. And oftentimes, if the prices rise too much, then whatever savings that you thought you were going to have because your interest rate is lower, you just totally wipe them out, because now you're paying 20, 30, 40, $50,000 more for the same house that you could have had at the current interest rate. And then you're also not talking to Matt to figure out, what amount of money, probably way less than you think, that you could use to buy down your interest rate and have less competition in the market, and have the price of the house be what the price of the house is now, and not get it jacked up at a super, fast rate if all of a sudden everybody else starts jumping in the market at the same time.
Yeah, yeah. I mean, again, supply and demand. There's going to be a lot more demand and still not enough supply. That's, it would be awesome if there was enough supply there that the demand would just balance itself out. But unfortunately, what we're also looking at is, 65-ish% of mortgages are below 4% right now. Well, those people are not exactly chomping at the bits to go and purchase a new house with a 6.5. Likewise, about 40% of people, for those that are worried about the housing market crashing or whatever, about 40% of people don't even have a mortgage at all. Their house is paid for. So it don't matter what interest rates are to them. But they also are not super interested in going out and selling that house, and the potential of, if they moved up, having to pay a mortgage at 6.5%. So, we're kind of at what we call like a lock-in effect right now, where people are locked into their homes because of their interest rates. Now, you got some people that are lunatics like me. Like, I bought a house here recently. I went from a 2.875 to a 5.99. I talked to a buyer the other day, and they said, "Hey, you just said that you moved up." Like, they were looking to go from their first home to the next home and start a family. And they were like, how did you stomach that? I was like, well, in my household, we started here with one boy at this house when we purchased it. Now we have 3. And for a while there, my home office was in the garage. Some of these podcast episodes were recorded in my garage from my end. I said, I stomach it because I got tired of being in the garage. Like, it didn't matter anymore. I wanted to be in the house. So I bought a bigger house. So, you do have a lot of that going on out there too. In addition to the first time home buyer age going from, on average, 5 years ago, 33, to, because of the affordability issues that have been created here by the supply and demand constrictions, the average first time home buyer is now 38. So, it's something that would be cool if it happens gradually, but you don't want to see rates move too volatilely, because that's where it's going to create some real problems with even being able to buy a house again for other reasons. A couple of years ago, what was the issue all the buyers had for you?
Oh yeah, I mean, at the point when we were coming out of COVID and interest rates were, below 4%, 3%, people were tired of living in the house they were living in when they couldn't leave it for a period of time. The market was crazy. I mean, you were seeing, 7 to up to 40 or 50 offers on one house. depending upon the house and how desperate people were and what price point they were at. So, I mean, you had to decide within 30 seconds whether or not you really wanted that house or not, because otherwise you're going to be too late and you weren't going to be one of the 20 multiple offers on it. So as economics change and as things shift, I mean, we have to stay on the pulse of that in order to be able to, for anybody that we're talking to, for anybody that doesn't think they're quite ready, to help people make decisions as to, I mean, even on the selling side, when that market started coming down, I mean, it literally, I was working with a seller that was in a neighborhood over from me, and he was rehabbing his house. And you could I just could just feel it. Like, I'm just telling you, because he kept taking more time and more time to fix this and do that. And I remember looking at it one day and I said, I'm just telling you, I said, based upon what I'm seeing, based upon what I'm hearing, my gut is telling me that there's another maybe 4 to 6 weeks before this market changes. Like, I'm just telling you. And I said, if you don't get this house on the market, you're not going to get the max that you could get for it today, which honestly is a number that your house should never have been worth, right? Because things jumped up 25%, 35%. I mean, it was just crazy. And I mean, sure enough, I made him do the last couple things. We put it on the market. We got a bunch of offers. And then I won't go into details, but the people making an offer were not the most upstanding people. So they had figured out a way to get out of the deal. So we had to get a second contract on that house. And that happened over probably a 4-week period of time. And from the offers that we were getting, like 3 to 4 weeks before that, to the offers that we're now getting 3 to 4 weeks later, you're looking at like a $20,000 difference. And I mean, he still was happy because he still got more for his house than he ever imagined that his house would be worth. But that is how fast the market can change. So when we're telling you that we're here to help you make smart moves, I mean, we're here when people say, oh, I don't think I'm going to buy anything for like 6 months. And I say to them, you really need to start talking to us now so we can understand your situation and we can help guide you. People just stare at me sometimes and I'm like, no, if you have some flexibility in your timing, we really need to start talking now, because for you individually, 3 months might be a better time than 6 months, or 8 months might be a better time than 6 months. Because everything's so different. And I think one thing that people forget is the interest rate for you, whoever you are, and the interest rate for your uncle or your next door neighbor could actually be different, because, I mean, we're talking about overall economic factors here. Matt can go into some other economic factors that affect interest rates, but people forget their own credit score affects interest rate. Is that not true?
100%. Yeah. I mean, not only just like people following Bitcoin, it's up and down, up and down, up and down, whatever. Mortgage-backed securities are doing that same thing, which means that every single day prices are changing on the interest rates. I can't control that. You can't control that. But if you know that, it helps educate the rest of your decisions, because there's about 40 other data points that you do have control over. To give you the high level ones, one of them is, where's your credit score at? Now, with a few exceptions, the higher your credit score is, the better your pricing is going to be on the mortgage. So the better you can push that up, good. Now, don't delude yourself. If you're already sitting around a 700, like don't camp out and wait on a 750, because the difference in price that you'll run into there is probably not significant enough that the market itself may not fluctuate by that much over the period of time you're shopping. But if you're, at a 620 and you've got an easy path of paying off a credit card or something to boost it to a 680, hey, that could save you quite a bit of money. And it may be that the amount of money it's saving you is what you wind up using to pay off the credit card to begin with, versus having to put it into your mortgage. Another thing is like the area that you purchase in. That's going to dictate your interest rate to a certain degree. Sometimes state to state, county to county are going to have different price adjustments. How much money you put down is going to change your interest rate. And it's not 100% always that putting down more saves you on the interest rate either. So, just throwing that out there. For example, you get a little better pricing if you put down 19% than if you put down 20%. Another thing is if you get, depending on what program you're working with, they're all going to be priced out a little bit differently. outside of the interest rate, the different programs, especially when you get into government loans, they're also going to have funding fees, and they're going to have mortgage insurance premiums and things like that that you have to pay that don't necessarily go away when you've got 20% equity. So, those are the ones that you've got some degree of control over yourself. But the list just keeps going of all these things that are going to change your rate. So yeah, I'll talk to people all the time, and they're like, Uncle Billy at the cookout said that he got a rate that was this price. And I'm like, Uncle Billy's either a liar, got excellent credit, or not you, Here's another fun fact. If you're shopping for interest rates online, just hang it up, because what you see is not real out there. What you're seeing there, for you to properly compare apples to apples, you need to be able to see all the prices of all the lenders at exactly the same time. That's something that I do, not for all lenders literally, but for at least, a dozen or so per scenario. I can see them at the same time. So instead of you driving around, I always compare it to gas prices. If you're driving around town looking for the cheapest gas, by the time you finish the loop, the cheapest gas might be a different gas station than you started with. And now you're running on E with it dinging. So guess what gas station you got to stop at? The one that's right next to you. Whether it's the cheapest one that's got the crackhead out front and the light flickering, or if it's the Buc-ee's that's probably not so cheap and also not cheap on the barbecue sandwiches, but delicious nonetheless. So, mortgages are going to be, I'm hungry. It's lunchtime, guys. Mortgages are going to work the same way. Like, you don't want to be online searching around for the one that's got the homeless guy out front about to, stick you up for $15 to get inside and get him some gas station hot dogs and a corn dog. You want to go to the one that can help you shop across several. And you also want to consider the fact that the pricing is going to move as you're shopping. And online, I've seen things like they'll quote it with 3 points, which is 3% of the loan amount. The number of loans I've closed in my career that somebody actually paid 3 points on, I could probably count on one hand, because it's just not usually financially a savvy thing to do. They're also typically charging some sort of obscene origination fee in those scenarios. They're also telling you that the only way you qualify for it is if you've got an 800 credit score and $1 million purchase price and a $600,000 loan amount, and you named your firstborn kid after your mortgage originator and have a unicorn for a pet. Like, somebody out there might do that. But that crazy low rate that you saw, that ain't the real rates. That's not what's actually going on for real people. My best advice there would be, if you wanted a general feel without feeling like you're being sold to, there's a website that you can go to called optimalblue.com. Just Google Optimal Blue Rate Index. And that's going to give you, without points considered, the average interest rate locked across the industry for FHA, Fannie, Freddie, the whole 9 yards. That way you can see on average what things look like. Now, keep in mind, you have to decide, are you average? If you've got a 600 credit score, you are not average. Your pricing is not going to look as pretty as what you see on that. Likewise, you may be a little better. It's an average. You may have an 800 credit score and you get better pricing than you see on there. But that you can use that as a rough litmus test. Typically, from what I see, it's about, for most people, they would pay a point, maybe 2 points to get the price that you see there most of the time. But it's public information that'll give you a realistic view that's not, if you go to LendingTree, all they are is a lead generation platform for lenders. If you go to Credit Karma to look at your credit score, that's not really your credit score. All it is a lead generation platform for lenders. I've had people tell me in the past, yeah, not with me personally, but like, I used your company because Credit Karma told me they were the best. I'm like, you want me to tell you a little secret? It's because my company paid Credit Karma to say that. Holy crap. We just figured out how e-commerce works. Not to put my own company on blast, they all do it. That's how it works. But keep that in mind. Like, that's Optimal Blue Rate Index. That's about the only valid spot you can go get a good idea of what real interest rates are in real time any given day.
Well, there was a lot of amazing and truth bombs, I guess, in there. That was a lot of great information and information that nobody really talks about, and that people probably didn't completely understand, but that's why we're here to break it down for you. And it's easier to break it down for you when we're talking to you about your specific situation. I mean, we do give you general definitions of things and explain things, and I have a couple of quick follow-ups for Matt real quick. But I mean, overall, if you didn't gather, all of that basically should tell you that there's a lot that goes into the equation. And there's a lot of things that are said out there and done out there that are truly just marketing. They're just trying to bait you with something that sounds amazing that only maybe one person in the universe can qualify for. I mean, there's one lender that I know that I will not name. A lot of times I hear her talk about products that are so amazing and that they're made for this and they're made for that. And then when I call and I talk to her actual loan officers about them, because it sounds like a very specific scenario that would work well for a client that truly is kind of a unicorn, they act like they don't know what I'm talking about. Because nobody bothered to even tell them if it was an option because they knew that no one could even qualify for it. So all of that to say, be very careful who you're listening to and what you're listening to and the advice that you're getting. And, I would say the preconceived notions that you go into, you should probably wipe a lot of those out of your head and just start with a blank slate and let, Matt walk you through them from the get-go. There was a couple of things. One, I want to ask about that you touched on. I mean, before I got into real estate and really looking at this stuff seriously, I would have thought that interest rates change like once a week, at most maybe once a day. So tell us the true skinny on how often do interest rates really change?
All day, every day. I mean, back to the gas analogy, it's just like that. Like you could literally call me in the morning and I tell you one thing and call you in the afternoon and it's changed. When you've got the full tank of gas, it doesn't matter what gas prices are. It matters whenever you're empty, right? On the mortgage front, you can lock once you've got a contract on a property. So we have to have something to lock it on. Now, we've got something called lock and shop, but I'll go ahead and spoil the surprise. It's more expensive than if you just wait and lock. So lock and shop makes sense if we think rates are going to go up, but in a stable environment, it doesn't make any sense.
So one of the things that you've mentioned a few times that I wanted to ask you about is you keep talking about locking and interest rate. So can you explain what locking and interest rate is, and then also explain when and what is a strategy around that concept?
Yeah. So, I keep talking about how interest rates change all day, every day. Locking it in just simply means that you're making it where your interest rate for your loan isn't going to change anymore after that point. So essentially, I wish that I could predict the future and tell you, hey, you just got a contract on this house. We should lock your interest rate next Tuesday because that's going to be the best pricing in the next 30 days until you close. I'm not a wizard. I can't do that. If I could do that, I would probably go bet horse races or something and make a lot more money that way. So what I typically recommend people do is when you've got the contract on the house, lock the interest rate so we know it's not going to get any worse. My company on a lot of our products offers a float down, which means that if it gets better during the time frame that you've got a contract on a house, we can let the rate get better with you and float it down. That's only during the contract period. Like once the loan's closed, it's your house. At that stage, we can't change anything without refinancing it down the road. But we try to give you the ability to have the best of both worlds. So I always tell people, I'm like, lock it so it doesn't get worse. And if it gets better, you can have that too.
Yeah, that's awesome because I don't think all lenders offer that, do they?
No, not completely. Not even all my products offer it, to be honest with you. But as much as possible, that's the way we will structure it.
Okay. So again, that's why we need to walk through everybody's individual scenarios because, a lot of people want to try to lock their rate before they have a contract. Can't do that. You actually have to have a house on a contract. It would be great if you just called up and say, hey, interest rates are at 5.5% right now. Can I just lock that in for a while and then I'll go shopping? That would be awesome, right?
That'd be great. And that's actually how some of the less honest lenders will get you. They'll say, oh yeah, rates are this, fantasy number. And then whenever you actually get your loan estimate and it's actually locked, you're like, hey, why am I paying you $20,000 in extra closing costs? And like, oh, well, we didn't talk about that part. Of course you didn't. That's why that's why the interest rate sounded that much better. I've had that conversation countless times with people. And then, come to find out, the unicorn didn't exist. They as it turns out, like I mentioned at the beginning of the call, everybody is locking and everything based on the mortgage-backed security market. So it's all the same source of money. So it can only be within the same, a few dollars of price point, or somebody's losing money, right?
Yeah. I mean, one of the tricks, and then we'll wrap it up, but one of the things that we've had happen with a couple of our clients actually very recently is they will get a pre-approval letter from someone really quickly, and they will also get an interest rate and a proposed payment. And then when Matt looks at it and tries to compare it, oh, they forgot to tell you they were thinking that you were going to pay extra money up front to buy down your interest rate, and oh, we didn't bother to tell you that part. Isn't that correct?
Oh yeah, yep, absolutely. There's no such thing as a free lunch, and there's no such thing as a substantially different interest rate than the market interest rate without somebody paying for it, and it's probably going to be you.
That's right. So anyway, that's a great note to end on. So again, if you have any questions, we are here to help you make smart moves and strategic moves when it comes to real estate, when it comes to buying and selling, when it comes to financing. And we didn't have a lot of life advice in this one, but sometimes we throw that out there too. So anyway, thanks again for watching. This is Smart Moves Podcast. I'm Ann Riley Caldwell, not your ordinary agent. And I'm here with Matt Wilson, loan officer with branch manager with New American Funding. And we will